All right. So, I thought I would start with a trade that I've had on for a little bit. This is an Intel trade. I bought the 30 strike call for basically $1.50. I've had this on for 43 days, so 2 market months. And at the moment, it's up $700. Now, I could just close it and take the $700, right? Why not? I mean, really, why not? Just take my money and go. But what if there's more? And I don't think that I'm the only one that ever feels that way. Like, can I get more out of this trade? What could I do with it? What's my risk? What could happen? So I thought with all of those kind of questions, why not just show some of the things that we could do here? One of the things being obviously we could just close it. That would lock in our $700 and we'd move on to something else. This trade has 112 days left. I didn't necessarily go that far out just to close a trade so early, right? If I had intended to close it early, then I may as well have used something a little shorter in duration. And speaking of shorter in duration, if we do roll, what happens if we roll it closer to expiration rather than farther away from expiration? Typically, people roll farther away. But since we have so much time, let's take time off. The reason we want to consider this is because, well, time is money. You've heard it. I've heard it. We all know it's true. Time is money. Usually, when people say that, they're telling you, my time isn't free and you need to pay me per hour. But whatever, time is money. If we take time off of this position that we're holding, they should give us money for it because we're cashing in some days. So instead of having 112 days to expiration, if I rolled it forward into the October expiration, which I'm a little concerned with because that's earnings, but whatever, that we're just shopping around, we're looking, then they are offering $485 in credit. What would that do to my position? Well, if I just closed it right now, I could get 700. If I take this, I still have a trade on that has 28 days to expiration. I've got a guaranteed no loss trade of $336 and the potential for it to make even more money. So I'm getting risk out. That's what we call it, quote, risk out. And I'm guaranteeing this trade with a bare minimum of 336. So no matter what happens, I would at least get that. Well, that's not bad, right? We get to keep the trade, we get risk out, we turn something that could later on become a negative into a guaranteed winner, and we can hang on to it. If I did this roll, we could also add a short. We could just come in here and, say we could sell the 36 strike and get $3 more in credit. That sounds good, right? I would probably add the 35.5 so that we could get another $325 in credit. So if we take 330 and 320, we're up to what? 650 guaranteed, no loss. That sounds pretty good. So that's one option that we could do with this trade is we could roll it forward in time and cash in some of the time, the theta that's in it. And it's not a bad choice, all things considered. I'm going to have to pay commissions and it will count as a PDT, right? It's a day it will count as a day trade or as a trade. So I couldn't, do 3 of them. Then I'd break the PDT with this account. So we could roll forward. From where it is just right here, I could just add a short call. Don't need to roll it at all. Just leave it where it is. And if I sell a call here for more money than the one that I paid for, remember I only paid $1.50 for that call. So if I can sell a higher strike call for more money than what I originally paid for the loan call, then I've got a free trade here. This is offering 780 in credit, 775. So subtract $1.50 from that, and that would be 625. That's $625 just mine. Now, the only problem with that is we haven't taken risk out. So this could fall out of the money, right? Intel could fall back down. These options could lose value. And for the short leg, so what? We sold it. We want it to lose value. That's okay. But for the long call that we have, it would lose all that profit that it has. And that's not cool. We want that profit. So while we can do this, what's the risk? Well, the risk is that we would give up our $700 profit that we've already got in that long call, and the $150 that we spent on that call, we would lose all of that. But we would still make 625. Worst case scenario, we would make 625 because that short call would be profitable if we fell out of the money. So that's option 2. Now, with this one, a lot of people don't like it because, well, we are already in the money. And that means you're carrying a short call in the money. And that tends to scare people, especially when we have earnings, possible dividend. There's a lot of things, but in the next 100 and something days. And that's a deep in the money call option. So I get it. A lot of people don't like that one. But we could sell any of these, right? Any of them. We would just get less money for it. Or we can stay in this expiration and we can just roll this call to the money, maybe even a little out of the money. So we'll just roll the strikes up. And we can see, hey, they're offering a credit, $340. Well, that gets risk out. So they say I'll have a risk free trade of $188. Where's that number come from? Well, remember, I paid $1.50. So if we take $1.50 and we subtract it from 340, we should get 190, right? Little napkin math, but that sounds right. So now I've got a free call that is mine that has 112 days to expiration, and I cannot lose the trade. And I got the same expiration. I can still later on add a short call whenever I want. I'm kind of partial to this one right here. This maneuver is what they call getting risk out because, well, my risk is the 150 that I spent to begin with. And we want to quote, get that risk out. If they're going to pay me 340 when I bought it for 150, then I get my 150 back and I get an additional $191 and I get to keep the call and see what else happens. But that trade could not lose at that point from then on. Or we can kick it down the road, right? That's the last scenario is that we go farther out in time. And as you can see, depending on where we choose to go here, It's not a lot of reward, and I have to go pretty far out on the chain just to see any decent credit. So if we go to 45, there's that $340 they were offering me, but I'm all the way out here at 45. I was at like 35 up here. Still, guaranteed, can't lose trade. Got $191 minimum profit. I get to keep my call and keep the trade, right? That is 265 days out. Lots can happen between now and then. And as a risk-free leap, that's not a bad way to go. Okay. Once you own this call, remember you can sell calls in the front. It's like a poor man's covered call. So if we don't roll it at all, if we just leave it where it is, we could become tactily nimble and we could just come in here and start selling calls. Like today, for an example, if I wanted to sell a covered call for today using the poor man's covered call tactic, I could come in and, if I wanted to, sell a 0 day call just for today. I'm not going to get anything for it. You can see there's like 6 cents here, but I could have done that this morning at the open, or I could sell one for next week, right? Any of these are covered because I've got a 30 strike call, so I can sell anything higher than a 30 strike. For those of you that do this, usually the long call that you have is way out of the money, and then the options that you can sell are also way out of the money. This will not increase my margin at all. In fact, it'll reduce my margin. Um, it'll reduce the restrictions that is placed on my trade from this. So I'll actually get margin back if I added a short call. So that's pretty cool too. Which means if we kick this thing out into January of 2027, I would have 500 days, 476 days that I could just sell calls against this thing all I want, making more and more money on a trade that can't lose. So I just wanted to share that with you guys because I know when I first started with options, when to get out was always the bothersome question. And if you stay in too long, you overstay your welcome, it starts to lose money. And then you're like, well, shoot, I should have just closed it when it was profitable. But then the next trade comes along and you close it because it's profitable and it just keeps going and going and going. And you're like, why the hell did I close that trade? Man, I should have stayed in it. I would have made so much money. These tactics help you stay in the trade and get risk out and still leaves a lot of options, quote unquote, on the table so that you can make more decisions later on. It's just a really well rounded way to approach a naked option position, which is what this is. I really think I'm just going to roll it up 5 strikes and get some risk out for now. That feels pretty good. We've got a lot of volume here, 10.5K. Open interest is 105K. Maybe I go a little farther out. I can get almost $300 if I roll out to the 40 strike. Let's see what I get there. I'm just going to work the order to fill it on the 40. If it doesn't fill in a little bit, I might give back some of that credit. I'm asking for more than they're offering, so it probably won't fill, but it's worth a try. Well, did I lose you guys on that? You a little confused, or are you good to go? Because I get it. It can be a little confusing. The the other topic is about these tools that we can all use, right? There's so many tools out there. And I'm just going to copy paste the whole thing. It was a question from the questions tab. So, of course, you could just, see it over there, but I'm going to bring it over so that everybody can see it. Don't have to jump tabs. It would have, absolutely, because Thinkorswim manages a role differently. You're absolutely right. It would have helped to see it in Thinkorswim. But this is why it's really important to keep track of the cost of that option when you get the option. And I can't stress how important that is. I've got a client who does his own thing and just really does not listen to anything. And he's taken every winning trade that he's had and broke it with covered calls, doing it wrong over and over and over and just losing money on winners. And I'm like, how do you even lose money on a winner? Like, it's a winner. What are you doing? And he's just new to options, right? So when you're new to options, you can make mistakes. And instead of listening, he just decides, oh, this sounds really good. I'm going to do this against my better judgment. He'll do it and then he'll say, "What do you think? That sounds good, huh?" Like, "No, you just lost yourself more money. What are you doing?" Right? So it can be confusing. I get it. And he's on a broker that isn't even designed for day traders. He's on a Fidelity account, which reminds me, I had logged into my Fidelity to see a covered call that I'm running because of that client, because we got to figure out what Fidelity does when you roll. I never trade options there, so I don't know. I have to find that out for myself too. But this Intel position, no matter what broker you use, if you keep track of the original cost of the option and then you look at the cost that it's going to take to roll it, because think about what a roll is. It's going to buy back what you have, and then it's going to, or in this case, it'll sell what I have and buy another one. So we can do the math ourselves. This option is trading at 840. I paid $1.40. Let's just use, round numbers to make it easy. I paid $1.40 and it's trading at 840. That's $7 of profit. So if I roll it, then they're going to give me $7 in profit, and then they're going to spend 390 to open a trade out here somewhere. That makes sense to me. It does take time though, right? And the difference with this broker compared to Thinkorswim is when I go to roll here, it's going to say, "Hey, we'll give you this much money and your new position will be this." On Thinkorswim, when you go to roll, they just show you a number, and what they're not telling you is that's going to be your new position. So that's a real change in perspective when that happens. All right, I sold a $4 strike call on ONDS, and I bought ONDS stock. I did this for a client just to do a covered call trade. So I got 100 shares at $4.20, and then I sold a 4-strike call, and I sold it for $1.19. The stock was up, it still is, 772, and that option right now is trading for, we can find today's gain lot last price is trading for 10 cents. We'll see. Let's see that. This might not let's see. Actually, let's just go see what that $4 call is worth. I think it's worth $4.10. There it is, last price, $4.10. So think about that. I sold it for $1.20, and right now it's worth basically $4.20. I'm in the hole $3 on that trade. And yet it's still not a bad trade. Hopefully you guys understand why. Let's look at it on Thinkorswim. ONDS. January call. I believe it was January. Maybe it was December. $4. Yeah, it's trading at 410. Yeah, December 19. So let's go to December. $4 call. It's trading at 410 on the ask. So if we split the mid, it's at $4 even. Well, I sold it for $1.20. That sounds bad, right? If I wanted to close this trade, I'd have to spend $300. And that sounds like loss, but it's not loss because I don't have to close this trade. And you could argue, but hey, man, it's a short call in the money. Yes, it is. And it's a $4 strike. But I bought the stock above $4. If they call away my shares at $4 a share and I spent 410 a share or like 420, I think it was, I'm really only losing 20 cents a share. But I collected a dollar something in credit. I'm not losing any money. I'll still make like 80 to 90 cents in this trade. So if I didn't understand any of that and I just come in and say, "Oh my gosh, this trade is down $290." I don't want to lose $290. I better close the trade. And then people will make a bad roll, make a bad decision, try to get out of it. Why? This is the kind of trade that one kid hurt himself. I don't. It's an old story. I don't know if you guys were trading then. Back in 2018, 2019, this kid was new to options, new to Robinhood, new to trading, and he took like an earnings trade on Apple or Amazon or one of those, and he had some positions like this. Well, he hurt himself really bad, and the parents sued because the kid wasn't even in a loser. It just looked like it was a loser. All he had to do was hang on to it. It would have been fine. It wouldn't even have been a loss. It was a really bad deal. So you want to keep track. What did I get this option for, or what did I sell it for? And the client that I was mentioning that keeps making mistakes, he aggregates all of his values. So if he had 10 of these, he'd say, well, yeah, I sold that for $11.60. No, you didn't. You sold it for $1.60, right? And then you sold 10 of them, or you sold it for $1.50, but you sold 10 of them and you got $11.50. Don't aggregate your numbers because you need to know exactly how much you bought it for or how much you sold to open for so that when you go to do the roll later, you can do some math because your broker might not show you the math that it's doing for the roll. 420. And it helps if you put lipstick on a pig, right? That's what we call it. So you doctor out the charts. 420 is what I paid for the stock. And you can do this with every one of your positions. It helps you keep track of what do I need the price to do? Because if you're like me and you're carrying, 150 to 200 trades, and then you don't look at them for 2 months, you can forget what did I need this trade to do? Oh, yeah, that's right. I needed it to go up. I need it to go down. I need whatever. So take a few minutes to annotate the chart and you can hide your drawings afterwards so that they're out of the way and you don't have to look at them all the time. They don't get in the way of your technical analysis. That's my average share price. And then I sold a call at $4 for 19 cents. There we go. That's better. OEX. Oh, well, OEC is me, right? That's the name of my company. And when I do analysis, it's OEC analysis. Where did you see OEC analysis at? Oh. I got you. That's called the Thinkorswim phase score, right? So on Thinkorswim, open up the little bars here on the side of your chart and choose phase score, and then you can build out your own individual phase scores. I made this one for the kind of analysis that I like to do on my charts, but you can make your own, right? It'll use your watch list columns and your options column indicators for your choices selection. It is kind of cool. Yeah. Um, I used to have more than this, but then I don't know, it was becoming too much and they did something and broke it. So now I just use this one. But you can put all kinds of stuff in there. It's kind of neat. And then, of course, you can just kind of tuck it up so that it only shows what you need. Yeah. So that's my average share price. And that's where, if I lost the stock, that's what they would pay me is $4 a share because I would get exercised and they would call away my shares. And that looks like I would lose 20 cents a share. But I collected basically $1.20. And so at the end of this trade, I would still be ahead by $1. That's $100 no matter what. And yet, if I look at my brokerage account, it says, "Hey, man, you're down 200 and something, almost $300. What do you want to do with this trade?" just nothing. Leave it alone. And I might roll it eventually later on if I can find a good value for it. But right now, I haven't found a good value for it. I don't want to lose my shares at $4 when the stock hit $8. That was a good stock trade, by the way. But if I do, so what? You know, this is why you don't sell covered calls on something that you think can run. And it's not because you'll lose. I'm not going to lose. I've got a winning trade here. It's because you're going to lose out on potential profit that you really could have had a great trade if you'd have just not sold calls at all and just bought the stock. That would have been a great trade. It's 100% profit, right? But I was trying to prove a point, and I needed to show him how Fidelity worked. So I went and sold a call on it. So, anyways, that's not ready to roll. Don't even need to look. Now, the discussion was doing cash secured put trades near the end of a market correction. So maybe we could look at something like what is down right now that might be good, maybe like Ford or something, AT&T. Yeah, AT&T's down. Maybe we could use something like that, right? Let's just say we're going to use AT&T because we need an example of why would we want to do a cash secured put? Well, suppose I want the stock. I could go in and I could just sell a put. And as long as you have the money to do that, you could sell that put what we consider naked. Although it's not naked, it's secured by cash. So you sell a put, they give you money for it. Worst case happens, you end up with the stock. SOUN. Thank you, sir. I'll use your example. SOUN. So in this scenario, suppose we want the stock, and so we're going to go in and we're going to sell some options on it. I've done AT&T so many times because I've got a client who worked there for like 30 years and they own shares because the company just keeps giving them more shares. But it's not a good one to choose because it doesn't have any volatility at all, right? So then you go to sell an option and you're not getting any money for it. Same with Ford. You just can't get any money out of Ford options on the sell side. So if we're looking at this, we're like, okay, I want to do a cash secured put. Why would we do that? Why not just buy the stock? Well, if you look at the wave kind of implies that we could keep falling all the way to 15. Why buy the stock at 16 if it could fall to 15? I could just go out there and sell a 15 strike put. Worst case happens is that it falls below 15 and I end up with the stock at $15 a share. But I also get to keep that credit. So now my average share price really wouldn't be 15. It would be 15 minus however much credit I got to begin with. Well, how much credit is there at $15? We can go in and look. So we'll just look at something that's close to expiration for the moment. Not saying that that's where we would want to be, but we need some place to look. So they're offering, we'll use the ask, although that's unrealistic. They're offering 85 cents. So we would end up with the stock at $14.15 a share because it would be $15 minus 85 cents. And that's 415. So now we got the stock with the average share price of 415 and we could then focus on selling calls at a higher price than 14 and then get rid of the stock and start the whole thing all over again. It's a nice little wheel trade. We could just run it in circles over and over. There are risks to this. covered calls and covered puts don't protect you if everything just crashes and burns into oblivion, right? So if we sold a 15 strike put looking to get the stock and it drops all the way down to $9, we're not going to be very happy about that, right? Because now we own the stock at $14.15 a share and the share price is at $9. That sucks. So just keep in mind, selling options against your shares is not a way to defend your share position. It only enhances a stock position that really isn't putting out that well. And that's okay, right? If you have a stock and you want to keep it, but it's just not performing, sell some options on it. It'll help boost your returns. But if you've got a stock and it's trash and it's losing and it's not working, don't think that you can sell covered calls on it and turn that loser into a winner because it won't, right? And it won't protect you either. Now, if it doesn't fall below the $15 the strike that we sold, we just get to keep the credit and then we get to do it again. And we get to do it again and again and again. And we can choose different strikes. We can choose, different expirations. We can just keep selling these. And eventually, someday, we would get assigned. But if you're diligent and keeping track of every one of your sales and you add that up, you could end up getting assigned at 14 someday. But if you did it for 6 months, your average share price could be $10 or $11 a share. So you really want to keep track of how much premium you're getting. Your broker won't do it for you, unfortunately. Some brokers will let you highlight only trades in that particular stock. And then, of course, it'll tally it all up, how much you've spent, how much you've earned, and you'll kind of see a P&L that way. But I think doing it by hand is the best. So if I was shopping around and trying to find stocks that would make good candidates for covered calls and cash secured puts, what kind of program would we want to use? There's a lot of them out there. Herein lies the rub. First, we need to define, quote, good companies to trade. And we've talked about this before, right? Things that are liquid and that meet our account size. You don't want to trade $8,000 stocks when you've got a really small account. You don't want to $8,000 stocks even showing up in your scanner. Spot Gamma, Trading Ticks, all those companies are not going to tell you if a particular stock is liquid or if the particular stock has strikes that are too wide or a lot of bag holders or if it's trash. You have to do that work yourself. Now, most of them will let you put your watch list into their platform. And if you read the request for today's stream, the request was unusual whales or trading ticks. When it comes to gamma exposure, I haven't been on the whales platform for a while. I don't have my access to that anymore the way that I used to, but I've got trading ticks and it's okay. I think their delta exposure is better than their gamma exposure, all things considered. Let me bring it up. I got to get logged in. That makes sense. Spot gamma is best for equities, or for indexes, not equities. Trading ticks is best for equities, not indexes. And so if you're looking at individual stocks and ease of use, trading ticks is your best bet. If you're willing to deal with things that are more complex and more expensive, then Spot Gamma is your way to go. And then for Whale Stream, I don't have access to them anymore. When I was there, they didn't have much on the dealer side or the I don't even know what that notable flows is from them. I just haven't been there in like 2 years. I haven't been there. So out of those three, Trading Ticks is very likely going to be the easiest to use because I can just hit price levels, whale targets, and just like that, I've got targets. So I can see, is it on support or where should I sell? Um, where should I maybe sell some puts, right? Like that 15 area right there. Yeah, we used to have an unusual Wells account for all of the bullish bears moderators, but over time we don't have it anymore. So at a glance, this is nice, and then you got the dealer positioning down here. So it's a nice combo between the two. And if you wanted to get more in depth than that, it's got tools, which you would want to watch their YouTube videos. But they've got additional tools that you can use to come in and dig deeper into anything like their analyst ratings, financial metrics, all that. As you can see, they don't have anything on SOUN. Let's put in something else, make sure it's actually functioning the way it's supposed to. If it's down, then there we go. See, put in a big name and you get results. Let's try one of those other ones. SoFi should be on there. Yeah, it's got ratings. This is a pretty comprehensive tool to give you just about everything you want. Peer groups, the estimates for the plus and minus, how their earnings is going, analyst upgrades and downgrades. I mean yeah, this is Trading Ticks and it's in the Discord, right? If you want to kind of just kick the tires and see if you like it, use the Discord because we've got some access to Trading Ticks right in the Discord. Yeah, it shows. Let's just start with this page, but I'll go back to that other page too. So from right here, I can just go to price levels, whale targets, and I've got targets just like that. I don't have to do anything more. And then down below, we can see how the dealers are positioned. And that's really nice at a glance, just like there you go. Whale targets, SOUN, right there. And then you can get your dealer levels. I think it's this one. It might be this one. One of those two. That's the profile. I think it's this one. No, it's definitely not that one. No, that ain't it. Well, that's no better than another one. Darn. Tell you another way to find that if they have it, because they might not offer it, right? Just scroll down until you find the Trading Ticks bot and then look at everything it has to offer. And what we're trying to find is the dealer, what do they call it on the website? The dealer deltas. Try deltas, right? Just go to the D's. That's the Trading Ticks. They're alphabetized. So dark pool density, dark pool levels. We don't want dark pools. We want dealers. Now Gex is dealer. They don't say that, but it's gamma values, insiders, IV, net flow, open interest, seasonality, sector rotation, support and resistance levels, top flow, unusual flow, whale targets, whale watch. So you can't get the dealer deltas apparently. You can't get that. That's too bad. That would be really nice to have that right on the chart. I could have swore we called it up and we had it on the chart, but I guess not. Which, they're not going to give us everything in the Discord because they want people to get their service, right? So there is this chart, and then there's this chart and this page. So on this page, I can scroll down and look at their earnings, analyst upgrades and downgrades, the volume by price. So, like a volume profile, this is their plus and minus on their range. And then if you want the peers, which don't discount peers, guys. The reason that peers are so valuable is let's say I like SOUN, but it has really bad options. So then I'm looking at it and I'm like, God, I really like this, but the options are trash. Pick one of its cousins, right? If you don't like Lowe's, pick Home Depot. If you don't like Pepsi, pick Coke. You don't like Facebook, try, I don't know, Google. Pick something else in the same peer group. So when you find peers, they can also become your indicator. If you're trading American Express, you really want to know what's Bank of America doing, what's MasterCard doing, what's Visa doing. They're going to be your bellwether to make sure that everything's moving the way it's supposed to be moving, going down, going up, whatever it's supposed to do. You get an outlier in one of those, it's an early warning to your trade. So I always like keeping track of the group. Sometimes that's really easy when it's banks and credit cards, things like that. But it can get really complicated if you start getting into cloud services or these new AI products, drones, or all kinds of stuff that's out there now where you're just like, how the hell do I find a peer group for this? What is this? So it comes back to like know your product. High co-integration. That's an odd word you don't see very often. Pairs or inverse pairs. Why is Goldman Sachs in that list? That's weird. And then of course you got seasonality, insider trades, which is really nice, and then a summary of the news. And that's not even all the pages, right? Because we can dig into its options, its dark pools, just so much stuff. They've got live scanners that are running at all times. We can see if it's been popping up on their scanners. This is not a bad way to go if you're looking to do like cash secured puts. If you was to choose something like spot gamma, it's going to be a lot more complicated. And I'm not saying that you can't handle it. It's just it's not going to be as simple as what we were just looking at. Let me get logged in and I'll bring over spot gamma. Now there's some really good stuff that spot gamma has that you don't get from Tradietics, like that founder's note. Sure, I post it every day, but I could get hit by a semi tomorrow and then, nobody's going to be here Monday to post the founder's note. Let's go to we can't look at the name we want on Trace, but we can go to tape and I think we can look up a individual stock on tape. I'm pretty sure we can because I seen the video there. Just gotta dig it out, I suppose. There's the name. Get rid of NVIDIA. Put the symbol that we want in there. Show me what I want, fool. There is no options flow for SOUN, but we could try, one of those others, and we can stack them. You notice how it's not telling me no? I can just add every name that I'm interested in, and if any of them get flow today, it'll pop up and let me know that my name that I'm interested in is getting flows. So we're getting some flows now. Here's the aggregate data on those. Lots of calls coming in. 892,000 in premium, 2.5 million delta, 11K in gamma. Some of these were flags. As we can see, they were a spread. So on this one that said buy, it also had a sell. It's a part of a spread. We can see if there was hit on the mid, hit on the bid, hit on the ask. Now, one thing I've reached out to them about this because I'm confused and they still haven't answered me yet. You've got volume, but you've also got size. And I've asked them yet, I haven't gotten an answer. If that's my volume, what the heck is the size for? My hunch or my intuition here is how many times it's happened. Well, that's annoying. All right. But this is all real time right now stuff. It's not going to be very helpful for answering that question. Where should I sell those puts? Or where should I look to get in? This is going to take an aggregated snapshot of what's happening in the market today, but it's not telling you where we came from. It's not offering any indication of where we're going. And you have all the power at your disposal to tweak out these settings as much as you want, but it's not going to really line you up. Options don't tell you where we're going, right? I know that that's often conflated on YouTube, where people say, "Yeah, I was looking at the options and it says, we should be long here, blah, blah, blah." Yeah, whatever. You can find unusual options activity that guides you into a long or a short and gives you clues on where the market's going. Don't get me wrong, but it's because there was unusual options activity that gave you that. Otherwise, without that activity, if you go in and look at the options, if there's nothing there, there's just nothing there. It's not because you can't read it, it's just because there is none. And if we did get unusual options activity, you would see it on Trading Ticks just as much as you would see it on Spot Gamma. That's right. Good technical analysis and fibs do that. The options don't. So this isn't going to help with what you're looking for. The Equity Hub, I mean, they've got some really cool stuff to where you can dig in and look at the volatility of the options that you're thinking about trading, how this particular market is doing. There's just so much really awesome, powerful tools. Most of this is day trade stuff. They got Hiro, spelled Hiro. And inside this Hiro, you've got the scanner down here. And we can look at any stock that we want. We're going to just swap to SoFi because we know we've seen a lot of SoFi action. And so I can see on the side here, what's the dealers? Are they net long? Are they net short? By how much? Where's the hedge wall, the call wall, the put wall, all that stuff. That's pretty helpful, pretty cool. But this chart, that's all 0-day stuff. And so it's not going to be real helpful on answering that question. And this is a very robust, complicated platform. I think you're better off with and it's expensive. That's like the biggest piece. Yeah, I don't think this is what you're looking for. I would say you're better off with this. The best approach would be to do your technical analysis on your chart, lay out your levels, and then come in and see if you can find supportive confluence, supportive data or supportive information that says those are good levels to choose because there's a well support or a dark pool print or some other thing that says that's a really good level. And it doesn't mean you won't lose, right? Because that's impossible. Losses happen, it's a part of trading, but it will help validate your technical analysis and get you in the right area. And if there's nothing there, at the bare minimum, it'll just tell you there's nothing there. Now, I want to bring up something that we don't talk about too much, but man, it's really useful. These guys get a bad rap, right? So this is a company called TipRanks. TipRanks doesn't have a bad rap. Analysts have a bad rap. Everybody talks trash on an analyst, because they're just paid mouthpieces, right? There's these guys, and we all know it. They're paid to write articles to make it sound good or not sound good. And to some degree, I won't argue with that statement because a lot of times that's true. But not all analysts fit that boat. And what TipRanks decided to do was to monitor every public analyst and see who's a paid mouthpiece and who's actually putting in the work. So if I wanted to look for a particular stock, for an example, SoFi, it starts out with a little bit of technical analysis. This is the high, the low, and the average. That's the highest price target from these analysts. This is the lowest price target from these analysts, and then the average price target for these analysts. If there's only one analyst, it's not much of an average, right? Just put that out there. And it's aggregating the high, the average, and the low. Go away. Now, I had told it I only want the top analysts, but I could have asked for all the analysts. The only time I choose that is if I look down and there's only like two down here, then I'm going to choose all so I can see what the rest of them say. But otherwise, I don't like choosing all. But you can rank your analysts so that you only get answers from guys with a very high scorecard. If they suck at analyzing the stock, well, then why would you want to hear anything that they have to say? When it comes to an analyst post, when you see the news and it says Deutsche Bank upgraded, blah, 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 it's just a headline. By itself, it means nothing. It's completely worthless. What we need is the background. Hey, why did you give it an upgrade? And if they say, oh, yeah, this merger went through and now the company is 5 times bigger and they bought it for, this much of a discount and is projected to make this much money in the next 2 years, well, that's a damn good reason for an upgrade. But if they just say, oh, I don't know, the stock chart looked good and, well, they own our news company and they told me to write this article, so I gave it an upgrade. Yeah, okay. I don't care about your upgrade. I don't want the stock. There's supposed to be background behind an analyst's upgrade or downgrade or hold or whatever it is that they offer. And that's where Tip Ranks comes in. And Bullish Bears has on our website a discount affiliate link so that you guys can use them. But I'd say just go try them for free, right? Get the 1 month free or whatever it is that they offer, um, and try it out. It's just called Tip Ranks. They've got all kinds of stuff on their website, and you can download the CVS file. You can do some really good stuff here. It's tied into the news. Apparently, you can trade now if you're connected to TradeStation. I'm not interested in that, but whatever. You can run screens. It does penny stocks. That's really unusual nowadays. So when I'm stuck on a company, say I don't know much about it and I want to know more and I want to know what's been going on, I usually come here. To be fair, I don't have to pay for it, right? This is given to me. And, if I didn't have it, I probably would not pay for it. I would just find some other tool to use. But still, it's a go-to, it's a source, and it helps you better understand what the analysts are looking at. If you don't have this, and maybe you're new to trading and you don't really think that you can make money on that yet, it makes it hard for you to want to spend money on a product if you don't think that that product can help you make any money. Then come back to Thinkorswim and go to fundamentals. We're going to look at SoFi. And up here at the top is analyst write-ups. So you've got one from CFRA, Market Edge, Argus, Morningstar, LSEG, and Schwab. Some of those may or may not work. So, it sounded like I just said there's six, but depending on the stock that you're looking at, there might not be six. If it's grayed out like this, then there's no data. And that's what it says for Argus, no data. Okay, so that's one that we can't use. Then there are dates. They may be hard to see in the stream, but the dates are right here. And if it's really old, like this one from Market Edge from May, well, that's worthless. So that's no good. We don't need to see that one necessarily. I'll argue in a minute why you might want to look at it anyways. So now if I want something that's current and updated, the Schwab equity rating from the 26th, which is today, that's the newest, most up-to-date rated analyst recommendation out of all of these. And I can see that before even clicking one button. So why would I want to look at Market Edge if it's so outdated? The reason is because their write-up does a really good job at looking at things, and it asks the question in their write-up, what is good and what is bad? And I like to know both of those answers. If it was bad in May, it might still be bad now. I might want to know what that is. So I would probably look at their review just to get their perspective on what they were looking at, even back in May. But I would be more interested in looking at the equity ratings from Schwab since it's the newest one. So I'm going to just click that button and it'll pop up, and this is the page that we get. Now, it's not tip ranks because it's only one analyst from one company, but it's free. It's a name that I know because they own Thinkorswim, and it's up to date. I don't care if it's a buy or a sell or whatever it is. I don't need to listen to this. If it says buy, I don't need to run out and buy it. And if it says sell, I don't need to run out and sell it. But they're going to give me information that I don't know. How is it comparing to its peers? What's their earnings look like over the last 4 quarters? Are things improving or are they declining? Right? Anything that I can get out of this that I didn't already have. What do they do? Who's running the company? Are they in a lawsuit? There's the write up. If it has a moat, it would probably talk about it here. Uh, if somebody in the peer group is outperforming, it would probably discuss it here as well in that same little spot. So if you don't have tip ranks, go to your broker. Thinkorswim's not the only one that offers what I just showed. Fidelity has this, IBKR has this. I think Robinhood now has some form of this. It's not the same as this, but it's kind of similar. I'm pretty sure Webull has something like this. Tasty, they all have this, right? Because it's all linked in there somewhere. Plus, you can always just go to their website. I think if I went to CFRA, I could find, their updated analysis for just about any stock we would want to look at. Just remember, whatever they're saying, buy, sell, hold, they're not, don't use that for your trading decision because we don't care what they say, buy, sell, hold, whatever. We just want the work that they did, the earnings numbers, the insight, the peer groups. That's the value that they offer. So it just saves us some work. I did some videos on that, deep dive on companies. They're on the Bullish Bears at YouTube. how to perform a deep dive on a company. And then I did a couple of examples. I did one on Disney. There should have been one like on, well, there's PayPal, Zoom. I did a couple of them, right, to show in action what it looks like. That's Thinkorswim. Can't really tell from the visual there, but it's a nice bit of work that I did on PayPal. There are some pitfalls that I want to help you with when it comes to this sort of question, right? It sounds silly at first, but I can demonstrate from experience why it's not such a silly thing. So here's Target. I learned a valuable lesson trading Target. Know what the company's widget is and anything that they're going to report. Most of these companies have a public face that they deal with. And they got these investor day conferences, investor day events, and public engagements that they'll do. It's not just earnings. And I know if you're probably hearing this and you're like, yeah, yeah, so what? Who cares? Oh, you should. One of the things that Target does every year is it makes projections about how its Black Friday is going to go. And then it makes projections about how its Christmas sales are going to go. Well, they're held to account. So if they make projections in November about their December sales, guess what happens in January? They come out and they report their Christmas sales. So if you go to get into a trade in January, around the second week of January, you're very likely going to have the stock dump right on your head, because if they didn't perform as well as they said they would, it's going to go down. Or if you shorted them and they did better than they said they would, it could pop to the upside and run you right the hell over. Who in their right mind is thinking about December Christmas sales in mid January? Not me. I went long in Target mid January and it just crushed my position 2 days later. Never saw it coming. But when I take a loss, I circle back and start asking questions like, what the heck happened? And this one, it really hurt. So I was looking for some answers like, what the heck happened to my trade here? Why did we go down so violently? They missed their projections horribly and it got crushed. Well, analysts on Wall Street already knew they were going to miss. It was not a surprise to them. It was a complete surprise to me. One, I didn't even know they were going to come out with a report. And two, I didn't know that they were going to fail in that report. And so I got my butt handed to me. And that was a loss I did not need to make. If I had just looked around even a little bit, I would have seen that everybody knew they were going to miss. Well, right now is a very difficult time for the market. The president just fired up new tariffs. He's reaffirming older tariffs, and we've got the looming government shutdown hanging over our head that they said was going to kick in by Wednesday, but we could get one big bill over the weekend and have to spend money, and we could be broke by Monday for all we know. And these won't be government layoffs. He's talking about firing anybody that gets laid off, and they'd have to get rehired to get brought back in again. The market doesn't even know how to begin to gauge that. So, trying to anticipate the influence of stocks onto the futures in this climate, that's a very difficult thing to do. From an intraday basis, it would just be the big dogs. The Mag 7 will influence the stocks, and if it's not the Mag 7, they won't influence the ES and the NASDAQ on an intraday basis. So that's easy enough. We can just focus on those 7 names. There was a request on all. Is that ALL or AII? Allstate is a financial company. It gets lumped in there with all the other ones. If you look at it on the monthly, it's sideways. So AII. Oh, wow. Well, their monthly looks really good. If we were using OCR analysis, it's higher highs and higher lows all the way up. Looking at it on the weekly, we had a nice scoop pattern, and now we've broke that scoop and we've started to head up. So we want to like a 50 and 100 on this, see where it gets us. It's really close to 200, so $23 is going to be a very difficult line in the sand. There's an old stock quote that says, if 20, then 40. And it sounds glib. It really does. The first time I heard that, I thought that's so cheeky, but I've seen it play out so many times. We're above the $20 line now. And if it can hold above 20, this will go to 40. But that doesn't mean it's going to go there this month, even this year. Just if 20 is then 40, that's a real thing. This is a very new company, all things considered. And when they're new like this, you have to be a little wary. There's not a lot of data. It's above its IPO, and that's really good. But what happens when it comes out of lockup period, right? And what that means is a lot of the investors that were offered early access to this had to sign papers that said they won't sell for X period of time after it goes public. Well, at some point, they are let loose from that lockout period, and they may very well just be happy to get the hell out. And when that happens, we can see it get crushed hard. And so it has to be a part of the analysis of how much was sold before it went public and what was the lockout period. Sometimes you can find that information on Google. It's all filed, it's all public info. It's just trying to find it can be tricky, but it's not a secret, right? They're not allowed to keep it a secret. They have to tell people. I would get that answer and find out, are we even done with the lockout period? Because if some of them only go 6 months, 1, 2, 3, 4, we've got 5 months showing. So maybe one more month and we're done. But some go for a year too, and if it's not going to come out of lockout for another year or another 6 months, we could see 30 along the way. The next issue is we're inside this situation. We'll just use this really big bar. We're holding on that 21 and we need to keep it. We got to get above 22 to get above 23. If we can't get above 22, we're going to retest 21 and come down to 20. And then what? Right? And we've got higher highs and higher lows, and it all looks relatively decent. But if we break trend, I think it'll unravel relatively fast. And we're getting a bit extended from the 10 period moving average, which is what I would consider the mean. So if it starts to fall, 20 is definitely on the table. And then you got to worry about reciprocation. Whatever you got on top, you're likely to get on the bottom of that 10. So that would get us all the way down to 16 and a half in time, right? If we fail 20, we're going to go back. I do like this though. It's a lot of IPOs get their butt kicked and this did not. And that's impressive. I can't tell you how shocked I am that as an IPO this thing did not get smashed. It's really nice. ALM. Hmm, that's also IPO, right? Alabama Power. Yeah. Yeah, yeah. Well, I've got ALM and it came up as Alabama Power. Yeah. Thinkorswim said, screw you. So I can't have that one. Let's try TradingView because Thinkorswim ain't having anything to do with those Texas exchanges. There's your Almonte Enterprises Industries, some penny stock, low float trash that woke up, came out of a stock split, and is what at 850 now? What'd they do here? A 2-3 split. This is junk. If you're playing with it, just keep your wallet in your hand at all times so that somebody doesn't liberate it from you. Did you guys see that interview that Jeremy did where they were interviewing this what do they call it? It's a repackage company or a resale company. The You put funds and monies into that company and then they sell you bits and parts and pieces of things like palladium and aluminum and all these exotic weird metals and uh, that thing's actually doing pretty good. You'd have to ask Jeremy the name the video so you guys could watch the replay. But yeah, a lot of those companies are doing good. I don't know anything about this company, but this split definitely has my attention. Low float, unprofitable. I would ask questions like when was the last time they issued and when are they going to issue again? Which I was getting to that after I was going to talk about the Black Friday and sales and when companies can come out and issue new reports. Another question to ask is have they filed to dilute shares or are they doing a buyback and grabbing shares, taking them off the market? When they file, a lot of them don't give a date. They'll just file and say, we reserve the right at a future date and time to issue shares. And then they'll give a heads up like 3 days in advance or maybe a week in advance of, hey, we're gonna dilute this week. And if you catch it, then great, you can get the heck out of the way. But man, if you don't catch it, it just washes the stock. Like when JOBY, a lot of these guys did it. Uh, Maybe it wasn't JOBY. Was it OKLO? Can't remember the industry now. There was a lot of dilution. We were talking about it in the chat. What sector or what industry? It's escaping me at the moment. I thought it was the EV market or the uranium market, but apparently it's not those two. It's one of the other ones. It might have been quantum that did it, but you want to be able to ask that question and you want to hunt around. That way you don't get in just to find out a week later that they're going to issue shares and just dump it on your head. So we found AII, Almonte, and that's a nice scoop pattern. It only owes us to the top. Um, it's cheap enough that you could buy some of it and just dabble, but I wouldn't size up in this thing. And you still have your control card. It's this big candle right there, $8.26, and to the downside, 745. You got to GTFO this, and if you can, then get through that high. There is a phrase that says if 10, then 20, but we got to get above 10 before we can use it. It goes from if 4, then 8, if 10, then 20, 20 to 40, if 80, then 100. I know all those sound very silly, but I've seen it happen so many times that I don't even laugh at it anymore. Where are they getting their metals? Did it say? I thought it did. It had a list of companies. I mean, that's nothing to sneeze at right there. 50% returns is really nice. Since June, you said? Yeah, I would be concerned with this high up here. But Adam Grimes has this pattern called a pre-breakout consolidation. And this looks a lot like that pre-breakout consolidation. The problem is you won't know until it does it. So it starts to form, and you can say, yeah, that looks like pre-breakout consolidation. But if you're wrong, it's going to break that lower level and come down here and close this gap and maybe more. So then, you end up get a little nervous. But if you're right, and that is a pre-breakout consolidation, the bare minimum on a day, week, month chart is 50%. So you can take this zone and look at 50%. That's $10.80. Not bad. That's a $2 move. 220 really. So that's good. I wouldn't get in it, but uh, small caps have been doing really good. And then the other one, ATAI. Is this also a Texas one or? Okay. Wow, that's like a 45-degree angle, all right? Up and to the right. Textbook. I don't think you can get a more clean example of a trend than that. Really nice. So, for anybody watching, we've talked about keeping a Discord where you gather different patterns and setups and signals and strategies and concepts and you stick them all in that Discord. One of the things that I've done over the years is when I do come across a really good pattern, I grab it and I save it. You don't necessarily have to take this, what I've got on the screen, but you would want to get the name, right? Like ATAI, and put it in that Discord so that you can go back and do research on it later. Put your favorite indicators on it. You like maybe you like a MACD or a stochastics, Bollinger Bands, anchored VWAP, anything that you would want to use to better understand how to trade what we're looking at right here. Because everybody talks about buy low, sell high, get it on the pullbacks, trade the dips, run it to the right. But if you was trying to actually trade this, you'd have to just close your eyes and hold on for dear life like a bucking bronco because it had a lot of exit signals. And if you took those exits, it just left you behind and it kept on running. So you want to put a lot of work into understanding what's going on here to better understand how to stay in a trade longer. And there's a lot to learn from that one chart right there. That's a real beautiful pattern. I think that's where a lot of us struggle. The textbooks make it sound completely different than the way that it is. Look at how many exit signals there are on this thing. Everywhere you look is another exit signal telling you GTFO, just sell it, get out. And it just kept on going. From $2 to $6. Wow. So now we've had a sort of blow off top over here. We failed 550 and we came back in again. We want to see how it opens up next week. See if we're going to get an evening star reversal or anything like that. And even if we do, it's not to suggest that it's actually going to go down. We had an evening star reversal down here. It didn't do anything. It just cycled around and kept on going. Then there's the cup with a handle and a nice follow through, and another really nice pullback and more follow through. So for now, 550 is the line in the sand that we failed to stay above. Absolutely. Uh, for anybody who can't see what's being said in the chat, maybe you're catching this on the replay or something. What kind of market environment we are in matters a lot. If we're in a bear market, for an example, like we were in 2022, trying to take a lot of long trades in that bear market would not have worked. Could you find longs? Sure, there's always a long somewhere. But most of your longs or long setups straight out of the textbooks would fail in that bear market environment. Same thing, if we're in a really good, strong bull market, you will find bear signals all over. It, most of those signals are not going to work and they're going to fail, or that they're really short lived and they were gone in 2 days. And if you didn't monetize them, you missed them. So the kind of backdrop that we're in has a lot to do with it. And if it's a real confusing situation, say like it is right now, then it makes it even more difficult because if the backdrop is confused, there's no trend. And by trend, I mean there's no continuity. We've got trend. I mean, you can go look at all the stocks that have this up and to the right pattern. Even the S&P and the Nasdaq are still holding highs. Sure, I mean we're pulled back this week, but we're still holding up there. So we quote still have trend, but it's not a good time to be shopping around for new positions in a market that may have a government that's shut down by next week. New tariffs, a lot of uncertainties. They're cutting rates more because they're worried about stagflation and unemployment. None of those sound good. So there are times to just back away and not be shopping for new trades. We talk about subscriptions a lot, and I get asked a lot, "Hey, what's your favorite subscription?" But I don't even have one. It depends on the kind of market backdrop we're in. And if we're in a confirmed bull market and everything's good and we're getting forward guidance from the Fed and they're keeping rates low and we're in that kind of environment, I really like Investors Business Daily because these guys are great for long trades. For staying long and getting long and keeping long, these guys are awesome. But if we're in a bear market, I don't want a subscription here. It's completely worthless, in my opinion, for that. If you buy one of their extra products that they offer, you can get more out of them in a bear market, but that's more money. So I like to cycle my subscriptions based on what we have going on. In a really good bull market, these guys are awesome. If we're in a confusing market, then I like something that has more analysis to it, like Seeking Alpha. It doesn't have to be this, but something like this is going to be really helpful. Um, because they got a lot of data, a lot of information. They're looking around, and I gotta say, they bring so many stocks to my attention that was not even on my radar because I don't trade a lot of stuff that I don't know, and I don't trade a stuff that doesn't have options. Options are my way of protecting myself in a stock trade. If it doesn't even have options, I don't want to trade the stock because how can I protect myself? It can be, yeah. Seeking Alpha is not cheap, but I rotate out of what I'm in based on what I need. And every one of these companies are good for a particular thing. And I don't want to spend my money to have an account at every one of them at all times. So I swap out as needed. Right now, I'm using stockcharts.com. And my reason for that is this is the best place for macro and breadth. And that's the problem that we're in the market right now, right? Breadth, depth, and macro concepts are the number one focus and driver right now. So I needed a platform that gave me the ability to analyze that to its fullest. If you don't have the extra money to get an account at some place else, then just use TradingView because TradingView has a lot of macro data. It does. It's not as comprehensive, but in its own way, it's as comprehensive if you swap some things out, right? That way you can say it's not the same stuff, but it's comparable stuff and it gets the job done. Sometimes we don't even know where to go, you know? And I've been in those situations too where it's like, "Oh, I don't know." Yeah, it's a good scanner. The scanner was TradingView scanner filter stocks crossing above the 1020 EMA on a daily, plus 10% strung by analyst rating. That's a good scan. Now, see, my complaint when it comes to TradingView's scanner is, and I think they recently fixed this, but say I have a list of stocks that I want to scan from, and that's it. I don't want to scan the universe of stocks. See, they got watch list right here. I can now choose the watch list. But man, for years or for a long time, you could not do that. You had to choose the index, and that's what you was going to scan from. Because I like to focus on things that have liquid options, and I want to, if I'm looking for trades, then I want them to be in that watch list. In fact, now that I can see this, let's bring that list over, right? So we go to Thinkorswim, reset, and we want things that have weekly options and penny increment options. That is 330. And then let's do Marzidi's little add-on that says it needs 24-hour trading. See if we can get that number down just a little bit more. 24-hour trading right there. 80. Boy, yeah, we really cut it. I think that's going to be too tight. Never mind. Let's take that off. That's a little too tight for me. 330 names. Depending on your subscription level, you might not be able to get 330 names in a watch list. I'm just glad we don't have to type out 330 names. I don't want to mess with those two watch lists. I want to leave those alone. So after you make the scan, bring it up in your watch list and then export to file, and it'll pop up with something like this. It's a CVS file. Name it something so that you can find it again. If you're like me, you put little notes in it so that you remember to delete the darn thing. And then we head to TradingView. No, that's not what we want. Oh, we got to turn it from a text CVS. I should have just saved it as a text file, but that's all right. Take that file you got, open it up. Just go down the list. Should have alphabetized them first. That would have made my life a little bit easier. So it takes text. And now we've got our 330 names. So now that we got that, we can change the name of it here. And start a new scan. That'll be helpful if you want to break your scan down into individual indexes, like how many names in my scan are in the S&P or how many are in the Nasdaq or whatever. Then you can start applying your technicals, how many are above the 200, below the 200, which names are breaking out. Whatever it offers on TradingView for scans, you've picked the basket already for the stocks that it's going to find. This is how I do most of what I do, which is why I don't find unusual names or names that, people ask me about something. I have no idea. What is that? Because it's not on my radar. These are the ones that I trade. I only hear about new names when I'm doing themes, thematics, IPOs, or when someone brings them to me, which is why I like Seeking Alpha. They always brought names to my attention that I'd never heard of. And then, get out of your wheelhouse and get into something new. We've got that list now, which means I can share it with you guys. You don't have to do all the work that I just did. For anybody watching the replay, if you want to find the list that I just shared, use the search bar in the upper right and search for weekly options penny priced stock list. Right? I'm showing it right there on the screen. I'm sure if you type even some of that, it'll start to show up here in the search bar. But use search for that and you'll find this watch list. You'll be good to go. Right? If you want the one from Thinkorswim, I'll put it right below there. That way, if you're not on TradingView, then no worries. You just get the Thinkorswim version. All right, that covers both of those. So some ideas on how you might want to filter that is think about it from this point of view. If the stock, let's bring this down to a single chart. If the implied volatility is low, you're probably better off buying options like call debit spreads or put debit spreads if you want to go short, but you want to buy options, not sell options. If the volatility is high, then you're probably better off selling options, selling a call, selling a put. And it's not to say that if you don't do it this way, you're going to lose, right? You can buy options when volatility is high. You can do that. And you can sell options when volatility is low. Yep, that's true too. But you'll be fighting against the system if you do that. The way that I get around that and that I kind of cheat is because I trade those options near the money or at the money, right? So that if I go in and I open a call credit spread, if I do it at the money, then my volatility is shared, right? You're selling a volatility, you're buying a volatility, and they are very close to the same, and they're at the money. They're going to cancel each other out. You've reduced your exposure to that volatility until you get really close to expiration. But if you do it way out of the money, they're skewed and you're going to be offset on one side. And as you get closer to expiration, one's going to really outperform the other. You're going to feel that volatility. It's going to hurt, especially if you're doing it naked. If you're just buying a call on your way out of the money, your exposure is different. So I kind of get around the volatility by trading at the money, near the money, and it helps a lot so that I can take long calls or long puts in a high volatility environment, or I can sell options in a low volatility environment and I still get cash. They say don't sell options in low vol because you just won't get any money. Not the way I do it. So you could think about separating that list between high volatility stuff and low volatility stuff. Then you can also think about separating that list between what has already reported earnings and what has yet to report earnings. Earnings are just about to kick off. We're going to be starting a whole new season all over again, and it starts with the banks. So obviously, they're going to kick off first, and then we'll deal with everything else after those. But we're going to still be getting reports from companies all the way up into the banks when they start. So even though even though banks kick everything off, we're still going to be getting earnings all the way up until the day that the banks do start the whole new cycle over again. And that is, um, it looked like it was my wife's birthday, but no, it's one day later. October 14th is going to be the first day of the new earnings cycle with the banks kicking it off. You could also separate or think about separating them between which ones are, quote, good or healthy or strong. Are they above their 200 or are they below it? Because I don't like looking for long trades if it's below the 200, for an example. Long term, long trades, right? Like I'm going to hold it for 6 months or a year, those kind of trades. I don't want to get long on a stock that's under the 200, especially if that 200 is pointed to the downside. Can't think of one off the top of my head, but I'm sure there's plenty. Maybe Home Depot. So by filtering the stocks down into groups, it can just save you some work, right? It's some upfront work now, but it saves you work later on. And if not, just use the filters in the watch list to separate them that way. It doesn't have to be a perfect science to this. Carvana always makes such a great example for what we want to talk about. So, as you can see, I'm using Carvana like a 5 year chart. We got that purple line, which is what I use for the 200 period moving average. And while we were underneath that, it was not a good time, right? You could find up trades. There was some times where we went up. They didn't last long, and for most of them, they didn't have a very good follow through. But there was some upward movement when we were under the two. For the most part, trying to go long under that two was just a really bad idea. And then we transitioned. We were chopping about that 200 for a while. What is with this drawing tool today? Quitter? I'm gonna kill you. When you're hovering around it and the 200 is kind of flat, not a good trading environment, right? Sure, it worked out this time, but it didn't have to. Okay. So it's the same thing. Hey, you have a good weekend. Thanks for bringing those names to me. I'm going to dig into those more. I don't even look at the Texas Exchange, and I need to. Really, I do. I need to not just dismiss it so easily like that. So I appreciate that. It is. It's new, but you know, everything I've seen so many changes in the last well, since I started trading that when new things come along, you got to get in there, roll your sleeves up, and I didn't. I have completely ignored Texas and that new exchange, and that's missed opportunity. Really, could have been making money over there. So, guys, bring up a Carvana chart one of these days, put a 200 on it, and let it give you really great examples of how the 200 can keep you in the right direction. We're not saying that all stocks have to look like that, right? Please don't mistake me that way, but there's a lot to learn from the way that we digested that 200, the way we were extended above it, and just bring up your favorite stocks, or even just the Mag 7 group and look at the way that they, interact with that 200. Good stocks, good companies, they look a particular way and you can see it at a glance so that you get faster when you're doing your analysis that you bring up the chart and you're like, nope, I'm done. And you just move on to the next one. You don't even waste time on trash. Speeds up your day, it speeds up your life, which makes things so much easier. It's it's the weekend, everybody. I'd say we go get it. I didn't get my roll and I forgot to adjust the number on that thing. So I guess I'm gonna do it Monday. I was asking for too much. I should have backed it off a little. I should have backed it off a little sooner, and I didn't. So now it's down to 4.25. I could have filled at 440 and have been happy with it. We'll do it Monday. There's no biggie. That's the nice thing about having January options. There's no rush. As always, guys, I take requests. If there's a topic that you want to get into or questions that you have, these Wednesday and Friday sessions are my opportunity to help you dig into whatever it is that you want to dig into. And believe me, if you don't bring anything at me, I'm going to just look at the stuff I normally look at. It won't be like we won't have anything. Yeah, that's a good book, isn't it? I really like that book. Wish I'd have found it earlier in my trading career. I really wish. I could have saved myself so much work. Man, add to that one the hit and run trading. Because I'm telling you, when it comes to setup, that one is eye opening. And I don't trade the way that it uh, presents trades to us, but it really shows. Yeah, it's. I shared it, right? Just search it in the upper right corner. It's called hit and run trading. And that book also comes with a website. The short term, here's the book. Actually, that's somebody else found that one. If you wanted to buy it online, there's the book. But I shared it just last week. So you should be able to find. It's not showing up in the search, but it's there. I just shared it last week. So scroll up, you should find it. Um, and Swing Trade Bot is another one. That's a website called Swing Trade Bot, and it's connected to the book Hit and Run Trading. Right. So if you try any of those words, you should find them. And if you can't, I've got copies. I got so many copies of those things. Yeah, the John Grissom, or excuse me, Adam Grimes. John Grissom is he wrote The Firm. Hey everybody, have a good weekend. Hit me up. You got questions? I will see you all on Monday.